Hey everybody, it's Rob Foglia and Jessica Klein with Foglia Properties here at Keller Williams in Nashville, and we're coming at you today from basically on Friday, May 8th, to give you our weekly Friday live market update here on Facebook Live. As always, if you're catching us live on Facebook, leave a comment here. We'd love to interact with you, answer any questions that you may have. If you're seeing us on YouTube or anything, or in our weekly email newsletter. Definitely, we'd love to hear any questions that you may have. So either leave them in the comments on YouTube and respond via email if you have any comments or questions. We'd love to interact with y'all. You ready to get started, Jessica?
Yeah, ready.
All right, cool. Well, as I'm sure y'all have seen, at least in the title of the video here, we're going to be talking a little bit about buying a home in a changing market, in basically a market shift. And you may be wondering, what in the world are you looking at here on your screen? And we're going to get to this in just a second. The reason why we wanted to talk about this topic, though, is that I think people are, we get, and we were actually, Jessica and I were just talking about how the media sensationalizes things. And we don't want to ever be part of that sensationalism. We want to basically give you the facts. And at the same time, I've been hearing some of that sensationalism from some of our clients and prospects, and almost like fears, worries about the market and things that are happening as home buyers specifically. So that's why we wanted to just give you an honest opinion, because I mean, honesty is a pillar of our business after all. It's one of the values that we've built our business on. And so we wanted to just kind of give you the facts, let you know what we're seeing, let you know what the real estate market's doing, let you know what you're looking at here on the screen, and go from there. And so basically what we're looking at here on the screen is actually the stock market. It's not the real estate market. And I wanted to pull this up. And Jessica, what did I pull up? I pulled up the Dow, right?
Yeah, this is the Dow.
The Dow. Okay, perfect. I'm not a stock market guy also, so forgive me. I probably won't go too deep into stocks. However, I wanted to bring this up for a reason, and that's to show some of the peaks and valleys in here. I think because so many people's retirements are tied into the stock market, and because I mean every newscast you see something about the stock market, and people talk about if it's gone up or if it's gone down, and how much it's gone up or down. That this ends up being kind of what people think of as the finger on the pulse of the economy. And so if you look at where the stock market was here at its peak here this year basically on Valentine's Day this year, compared to when it dropped as our economy was kind of shutting down with all the coronavirus stuff, you can see a pretty substantial drop. I mean, what is that? Mental math, that's not always my strong suit. That's what, a 30-40% drop somewhere in there, right, Jessica?
Oh, Lord, I don't know the percentage, but it's a big one.
And so mental math is neither of our strong suits, I guess. No, I'm kidding. And no, I just say that though because ultimately I think when real estate consumers or just people in general, when they start hearing that and they start seeing such a big drop here, and even take that away for a moment, like even just look at what happened at the beginning of 2019 in the stock market, or at the end of 2018 here. I mean, a pretty good drop between those two. Even here, where there's a peak and a valley, we see all these peaks and valleys is what I'm getting at with the stock market. I mean, it's pretty volatile. And what did you say earlier? You were saying that it's almost like a reflection of people's gut reaction to what's happening.
Yeah, right? It really is. And with the stock market, it's so easy. I mean, in minutes, seconds, you can buy and sell stocks, you can move them around, it is just a gut reaction. And I think another thing that we were mentioning earlier, the media really likes to focus on the stock market because it changes so quickly. And because it's just like everybody out there doing whatever they want to in the moment, and you get these really big changes. And you mentioned something earlier that I think is also really important to look at. I mean, yes, we have that huge drop that we just talked about, and then instantly you see it go right back up, right? Mm-hmm. So the prices drop instantly, and then everyone else who didn't just jump out is saying, wait a minute, the prices are really low, time to buy up all that stock. And now we've already made up half of that drop. So it's so volatile and it's exciting, and that's why we see it so much in the media.
Mm-hmm. I agree completely. I think the media, honestly, I'm not going to get on tangent about the media, except I do think they do the best to kind of sensationalize so many things that are out there, and instead of just giving the fact, which to me that's what the news should be. But anyway, I don't want to go off on a tangent. I wanted to share this with y'all though for a reason, because I've been hearing it so often especially from some of our buyers recently, about how basically they're thinking the economy is going down, so home prices are going to crash, or they think that they're just going to be able to get a steal of a deal on a home. And I wanted to show y'all basically how this compares to the historical real estate market. So what we've got pulled up here is actually this. Now this is actually the max trend for prices. So let me go back to show y'all 5 years actually. So this is basically the same timeline that we're looking at here. This is a 5 year snapshot of the Dow. And this is a 5 year snapshot of real estate prices over basically since the beginning of 2015. And this is for Davidson County. It's all single family homes, keeping the same trend of the videos that we've done recently. If you're curious about your county, or say you have a condo or land or anything, feel free to reach out. We're happy to provide the same info for you for your specific situation. However, the reason we wanted to share this is you can see it's pretty straightforward. It's a very, very smooth trend line. I mean, it's not exact point A to point B the whole time, and yet it's just been a constant appreciation over the last 5 years. You don't see all these peaks and valleys in here because real estate's not as much of a gut reaction as the stock market can be. And even if we go back and look at see where we were when the real estate market was really down, when again, if you look back to the video from last week, you saw that this was the extreme buyer's market that we were in, 8, 9, 10 years ago. And even here, prices weren't going up and down. They hadn't plummeted. I mean, if you look at where we were in June of 08, even to say June of 10, that's not a huge difference. The average sales price went from 166 to 152 or 152 right here. So that's not like it didn't just plummet automatically. I just want to make sure that we're getting this across to everybody. It's even the median sales price, not the average sales. But still, it's you can see it's not a huge difference. And even if we look at average, you can see the same thing. It's just a little bit higher of a number, just because you got some more, luxury sales starting up. But anyway, you can see it's the same thing. It's not just a huge drop off. It's a very smooth trend line. I know we saw somewhat of a drop here, but I think that's more to do with the fact that this is when the system started calculating more than anything.
Right. Yeah. Yeah. I was thinking the same thing.
And so anyway, I wanted to make sure that we got that point across, because ultimately, and if y'all go back to, I can't remember if it was last week's video or a video we did recently on affordability, how affordability really is affected mostly by interest rates, not so much by basically by prices, because in fact, Jessica, you and I were just talking about this, right before our call here, how, we talked with 3 new buyers this week, I think 4 actually new buyers this week, new buyer clients of ours, and that they all have somewhat of a thought about price and thought about a deal when it comes to price right now. And they also, they're also kind of wondering about what's happening here, but they're also mostly concerned about a monthly payment. Because ultimately, whether we're looking for a $400,000 home or a $200,000 home or anywhere really out there, that number comes from their monthly payment, not for what they're actually paying for in a home. And so this right here is what plays into affordability a little bit more than home prices. This right here is the 3-year fixed rate mortgage average in the U.S. I mean, this is straight off of it's what stlouisfed.org. And so just for you to check out is, again, we're not mortgage lenders, so we can't necessarily go through and quote you a certain rate right now. But just to give you an idea of where rates are, where they were yesterday versus 3.25%, which is a phenomenally low rate. It's basically an all-time low if you think about it. But if you look at how volatile these have been over the last, even just the last month, how they've gone down close to 0.5%. And if you can go back to the end of 18, how they've gone down, what is that, 1.75%? That's a big drop, and that's what affects affordability more than anything. Just like if they jump from September of 17, 3.78% to November of 18 for almost 5%. I mean, that's more than a 1% rise in interest rate, and ultimately that's going to affect somebody's mortgage payment by 10%, or at least affect affordability by 10%, right?
Yeah, for sure. And I think something important to comment about here, I mean, just like we were looking at the stock market earlier, this is pretty volatile. It's volatile for a very different reason though. And interest rates are affected intentionally. They're not really a reflection, they're not a direct reflection of what's happening in, in people's minds. And it's not a direct reflection of, the COVID-19 issue. Stock markets are intentionally adjusted in order to create certain effects in the overall, economy. So this is really, it's volatile for a different reason. And you're right. I mean, these are extremely low rates, and the very highest that we've seen in this 5-year, trend is only 1%. Well, I say only 1%. It's 1% different than where we are now, approximately.
Absolutely, and well, actually, it's closer to 2. I mean, if you think back to where we were, and I went to a 10-year trend here, so anybody who was wondering why the screen changed, that's all it was. If you see where the max was here, or around 2018, I know
So 5 to 3, yeah.
But basically right at 5%, and right here we're down very close to 3, or getting to the low 3s, and so I mean close to 2% of a difference, and that's going to affect somebody's ability to buy a home more so than prices. Because and go back and watch any, if you're curious about this as a home buyer, go back and watch our video on affordability, because we walk through a couple of options, and basically your principal and interest payment for a home at say 4% for a $250,000 home is going to be about the same, within a couple of dollars, as a home that's $225,000, so 10% less, with a 5% interest payment. So, a 5% interest rate, excuse me. So that's, 1% difference in rate with a 10%, lower price is the same principal and interest, basically. So it's worth, crunching those numbers if you're curious about it. And then, I just wanted to share this with everybody, because you can see how it does affect things pretty dramatically. It goes up and goes down pretty dramatically as well. And honestly, I mean, this right here, like where my mouse is in the low 3s, and then right here in the mid 3s, and here in the low 3s, that's not sustainable for the economy. Like, there's a reason, if you go back and look, we'll see how far it goes back forever. I mean, there's a reason why it's almost never, I mean, this goes back to the early 70s here. There's a reason why that it was never here to begin with, because it almost doesn't make the lending process attractive for the person who's lending the money. Not for the actual mortgage lender, like the person you may be talking with to get your loan. I mean, like the actual institution, the financial institution that actually gives you the money to buy the home. It's not as attractive for them, because they're only getting a lower return. They're getting 3% interest rate on on their money that they're borrowing, or they're letting you borrow, excuse me, compared to say an 8% rate around here in the year 2000. And I mean, just think about your return that you're getting from a savings account, or from the stock market or anything. You'd rather get an 8% return than a 3%, right?
Right. Yeah. I mean, people talk about it all the time. Like, I'm lending money to the bank in my savings account, and they're only giving me a point whatever percent return. What's the point? That's exactly what these giant lenders are seeing in the overall market right now.
Exactly. And Jessica, you brought up a good point in terms of, like, it's not always, there's not an easy to identify factor as to what happens to make rates go up, other than sometimes lending, just the lending, like whether it's Fannie Mae, Freddie Mac, just like the lending, what the word I'm looking for? Lending giants, sure. Basically them trying to control affordability, or trying to not let our economy fail, because they know that this type of thing isn't sustainable. That's why we were starting to see it climb back up to about 5%. And then as some things start showing in the economy, they start doing things to try to get an influx of home sales, because ultimately so much is connected to a home sale, whether it's movers, whether it's a plumber to fix something for a home seller, whether it's a painter for that buyer who buys a home and doesn't like beige walls and wants gray walls, whatever it is. There's so much connected to a home sale that basically they know that that's going to help spark the economy. And so, as things go down, as the economy's hurting, they're going to try to keep rates low, but this won't last forever. And we just want to make sure we bring this up, because ultimately, if somebody's looking for a home at whatever price, and they're thinking, well, hey, rates are great, they're going to stay this way forever. I mean, ask the person who thought about buying a home at the end of 17 and then ended up buying a home at the end of 18, if the rate was the same. It obviously wasn't.
Yep. And all of these rates are extremely low, given, like that forever version of this graph that we saw.
Yeah.
I mean, look at that. Like,
right here,
it can't 18%. Stay this low forever. Yeah, I
No,
don't want to buy a home at 18%. I don't know about you.
no, definitely not. And I don't think I mean, I don't know, obviously. No one knows if it'll ever do that again. That's a little extreme. We haven't seen that in 40 years.
Yeah.
But who knows? I mean, it could easily, I could see it doing this again, 5, 6, 7%. I mean,
Yeah.
who's to say that it won't, you know? And so, you know, just throwing that out there for everybody, because it definitely could happen. It's just a possibility. And, you know, and one of the reasons I wanted to bring this up is, you know, and basically a graphic that we've shown a couple of times here in these videos, and that's just a very visual representation of a buyer's market and a seller's market. Because ultimately, we've been in this market that you're seeing on the screen right now, the seller's market, for so long in Middle Tennessee that, you know, I mean, just go back to 2014, you know, we were looking at last week actually with the market trends. And we were seeing how, you know, there was less inventory. There were more buyers out there than homes. That causes prices to rise. It causes more competition as a buyer. That's what we call a seller's market. The buyer's market was what we saw in 2010, 2011. There's more homes for sale, fewer buyers. That's why the prices were going down. And I wanted to throw a kind of a question out to you, Jessica, because ultimately, and just for us to talk about for a minute or two here, because ultimately I think so many people are thinking that this is where we're going. More inventory, fewer buyers. And, you know, and part of that being, you know, the high unemployment rate that we're seeing, you know, I mean, just, you know, everything. But at the same time, if we look at, just real quick, just to show y'all, because so we were looking, here we go, months of supply, you know, we were looking at, this is, again, the forever graph, you know, basically, at least how far our system goes back, that this is the balanced market. And this all here is the seller's market that we've been in. And, you know, if we're thinking, you know, recently that with everything that's happening, you know, more homes would go on the market, that this trend line that we were seeing go up, or if we look at the 3-year average, you know, we were seeing this trend line slowly go up, that it was going to keep going up. We saw it go down in March. We saw it stay steady in April. And we haven't really seen an influx of listings and influx of homes like to go on the market since, which would cause this number to rise and go back to a buyer's market. So I guess my question, the thing that I want to throw out to you is, what do you think would happen if the market, if like the climate stays in this type of seller's market, and it's just on a smaller scale, meaning there's less inventory, but there's less buyers too? Like, what do you think what that could look like?
Well, I mean, essentially that means a slower moving market, right? I mean, if we have the same number of buyers per listing, essentially, right? Like, so with fewer homes and fewer buyers, so everything just moves down together, then that just means more days on market for every home. And as a buyer, to me, because I'm a buyer basically, you know, hopefully in the next few months, what that means to me is I need to be really well prepared and know exactly what I can afford. And I need to figure out how appealing I can make every offer that I'm going to go out there and make. So I need to find a great house. And I need to make sure that when I come in with an offer, it's a serious offer and it's as appealing as possible as I can make it to the seller.
Mm-hmm. Well said, and well said. And I know we'll get you into a home, you know, sooner rather than later. And I think this could be the case. And we don't know. I mean, no one's got a crystal ball. I can't say for sure that, you know, 6 months from now, that's what we're going to see. That we're going to see. You know, this same type of, you know, months of supply, because that's ultimately what dictates if we are in a buyer's or a seller's market, the amount of homes for sale versus how quickly they're actually closing. And yet, if we are still looking at, you know, 3.5 months of supply, it's still a very strong seller's market. That's this. And it just may be even less inventory that's out there, even more buyers that are out. Because if you think about it, with the economy, what we've seen recently, with the, you know, with, again, high unemployment rates, you know, if we're in a position, mostly because of this, because of the low interest rates, that where their house payment is affordable for them. Like, say they didn't even buy in 2017, but they had let's just jump back to like 10 years here. They had bought here, well, let's go back to the max, that's even more extreme. They had bought in 2000 and their rate was 8.5%. And they survived the last recession. You know, they didn't even refinance at that point. They survived. They didn't lose their job. They kept their home. They've been in their home for 20 years. They may just be standing pat, because ultimately maybe in 2016, or they said, well, hey, rate 3.4%. I can refinance my home, keep my payment the same, and pay it off here. Or maybe they were in a position where they refinanced to just simply lower their payment, and it made just living more affordable for them. The reason I'm sharing this is I think there will be in the market that we're going into less people who like must sell. One of the reasons why, and I know I'm jumping back and forth, also forgive me. However, one of the reasons why we saw this, there were more people who had to sell. They were locked into higher rates. They couldn't afford their house payment any longer. They got behind on their mortgage. That was when we saw, more people defaulting, more foreclosures. Short sales were a major topic of discussion back then, because ultimately there were people who were underwater on their home. They had to sell, and they couldn't sell basically and make the amount of money they needed to make. Like, that was all happening back then. Whereas right now, that may not be the case. We may not ever see that happen again. So I'll be curious to see what happens moving forward if we're looking at this just on a smaller scale, like you said, and ultimately that just may mean less options for less buyers, and at the same time, that's still having that competitive market that we've seen. I mean, it's just a possibility,
Yeah, absolutely. And in the end, I don't think that we're going to be in a position where we see any really dramatic changes in any form or fashion in the real estate market. I mean, if we see things, they're going to be steady, just like they've always been, little adjustments, and we just move on this smooth curve. And that's what all the data in all of these videos we've been looking at is showing us.
Absolutely. Because, I mean, even if you look back at the 12-year trend that we're looking at on this graph, I mean, this trend shows smooth curves. I mean, yeah, there's a couple of pretty significant jumps here, where over a few months it changes by, half a month's supply. But ultimately, this is a smooth run for 12 years. Yes, it has its peak and it has its valley. And at the same time, it's smooth numbers, like I'm saying. It's the antithesis of, not this, excuse me, of this, where,
Right.
it goes from 1 week to, or, in a 2-week time period, or in a 1 month time period, maybe a better way to put it, it lost 40% of its value. Like, that's not the market. So anyway, we just wanted to share this stuff with everybody, again, to just give you all the honest facts, let y'all know what we're seeing in the real estate market, let you know kind of what to expect as well, to be the educators, to bring you the information that hopefully you're needing and finding valuable here. I know we're already close to got probably about 25 minutes, so I don't want to keep this much longer. But if there are any questions that are on Facebook, Jessica, I don't have Facebook Live pulled up. If there are, I'm happy to answer any.
Yeah, we don't have any at the moment, but as always, if you're watching this video a little later, go ahead and either comment, or if you're watching the YouTube channel, just comment there, or you can email us. We're here to answer any questions, or to show you different areas, or do additional analysis, or whatever helps you.
Absolutely, absolutely. Well said, Jessica. And I do appreciate the feedback. We've gotten some great feedback on these videos here over the last couple of weeks. So definitely, I'm glad that some of y'all have found this stuff valuable, and we're going to keep doing them. We're going to plan to keep doing them for the foreseeable future, just to, again, keep y'all informed, let y'all know what we're actually seeing in the market, just in real estate in general. And so that way, you know how to make the right decision for you and for your family, and just for your financial well-being too, moving forward. So that way you're not making the panic move like some people in the stock market. No offense to stocks or anything, but the panic move where you're selling low because you're concerned that this isn't the bottom or anything like that. We want to make sure that we're giving you the info to where you can kind of ride the wave, the real estate waves that we see. And so cool, y'all. Well, I appreciate y'all checking this out. If y'all do need anything, like Jessica said, give us a shout, either comment, PM us, either way. You can email us, info at Foglia, Foglia properties.com. You can also give us a call, 615-591-5665. And as always, appreciate y'all checking this out, and I'm sure that we'll be talking with y'all soon.
Thanks. Bye.
Thank you all. Bye.